Okay, let's dive in. Welcome to the deep dive. This is where we take all the material you've gathered, the articles, the research, notes, whatever you've got, and we really get into it. Pull out what really matters.
Yeah, think of it as cutting through the clutter for you.
Exactly. A shortcut to getting properly informed. And today, we're looking at Houston American Energy Corp, tickers HUSA. You sent over this whole stack of sources analysis, company filings, research reports. Quite a bit to sift through.
And our job here is pretty clear. Filter out all that noise around HUSA and pinpoint the really crucial takeaways from this material, especially if you're trying to figure out, what's going on with them now and maybe where things are heading.
So looking at these sources, the first thing that really leaps out is, well, the stock price went nuts recently, didn't it? Around mid-June 2025.
Oh, yeah. That surge. The chatter, at least according to this material, tied it almost completely to the geopolitical situation heating up in the Middle East.
Ah, right. Concerns about missile strikes, the Strait of Hormuz, that kind of thing, impacting oil supply.
Precisely. That was the narrative driving the speculation.
Wait a minute. The sources are clear here. HUSA's operations, their actual assets, they're in the U.S. and Colombia, right? Not the Middle East.
Exactly. And that's like the first huge insight this material gives us. HUSA has zero direct operational exposure there. None.
So the stock price was rocketing because of Middle East fears, but the company itself isn't involved there. That's quite a disconnect.
It is. And the sources really flagged this early on. The stock was acting, totally detached from the company's actual business, driven purely by external speculation, headlines. It tells you right away you need to look beyond the news cycle to understand HUSA.
Okay, so if it's not about their current oil and gas stuff suddenly becoming super valuable because of geopolitics, what is the fundamental story here, according to these sources? What's really going on inside the company?
Okay. That's where it gets really interesting, looking at the corporate details, not the market frenzy. The research shows HUSA is in the middle of this. Well, radical strategic shift. High risk, too.
A pivot, right. Moving away from being just a small oil and gas explorer. Because those legacy assets, the sources suggest they weren't doing great.
Underperforming is a polite way to put it based on the analysis, yeah. They're trying to become something completely different, and it's driven by acquisitions.
Right. I saw two mentioned prominently, Abundia Global Impact Group, AGIG, and RPD Technologies.
Exactly. AGIG is the big one, focused on renewables, fuels, chemicals. RPD is more of an R&D outfit. And this isn't just, adding a new division. The sources paint this as a fundamental reinvention of the company.
Okay, let's unpack that AGIG deal first, because the structure, wow, the sources call it basically a reverse merger.
That's the functional description, yes. And the key number, the really startling one from the material. When this deal closes, the original AGIG owners will hold 94% of the combined company.
94%. So the original HUSA shareholders are left with just 6%.
Just 6%. It's massive dilution. And what it means, as the sources explain, is that AGIG, which is a private pre-revenue company, is essentially using HUSA's public listing to get onto the market.
So HUSA becomes a sort of shell for this new renewable venture.
That's a very accurate way to put it based on how the sources frame it. And that dilution, that 94%, was apparently significant enough that the material notes a law firm actually launched an investigation into whether the deal was fair to those original HUSA shareholders.
Governance questions right off the bat, then.
It certainly raises them, yeah. The deal needed shareholder approval, got that in April 2025, and it's expected to close pretty soon, maybe end of Q2 25, assuming everything goes smoothly.
And what does AGIG actually do or plan to do?
Their plan is ambitious. They want to take plastic waste, certified biomass, and convert it into high-value renewable stuff. Sustainable aviation fuel, recycled chemicals, green hydrogen.
Okay, big goals.
Very. They've had a 5-year plan, starting with a facility in Baytown, Texas, using technology they've licensed. But again, the sources stress pre-revenue. It's all future potential right now.
So the big takeaway here, loud and clear from this analysis, investing in HUSA after this merger closes, it's not an oil and gas play anymore. Not really.
Not at all. It's a bet. A high-risk venture capital kind of bet on a renewable tech startup that hasn't made any money yet.
And those old oil and gas assets just become background noise, almost irrelevant.
That's heavily emphasized in the analysis, yes. Almost negligible in the new picture.
But what about the other acquisition, RPD Technologies? How does that fit in?
Right, RPD. That was announced back in December 2024. The sources describe it as a synergistic bolt-on.
Meaning?
Well, RPD is a contract R&D place. They've specialized in commercializing new technologies. They've worked in refining, petrochemicals, renewables. So the thinking seems to be it supports the AGIG plan.
Ah, okay. So AGIG has the big idea, the licensed tech, but needs help actually building it, scaling it up, and RPD brings that practical know-how.
Precisely. The analysis presents it as an attempt to de-risk the AGIG venture, which is, let's be honest, highly speculative. RPD has actual experience scaling industrial processes. Plus, crucially, RPD already has revenue.
From contracts with other companies.
Yeah, working with major petrochemical firms.
Yeah.
Now, that revenue is likely pretty small compared to what AGIG will eventually need, but the sources suggest it could help offset some of the cash burn from AGIG's development and maybe add a bit of operational credibility.
And they plan to put RPD right next to AGIG in Baytown for seamless collaboration, the sources say.
That's the plan described, yeah. Foster collaboration, find some efficiencies. It looks like the new leadership understands the massive technical hurdle AGIG faces and is trying to bring in some help upfront via RPD.
Speaking of new leadership, this whole massive shift didn't just happen organically, did it? The sources connect it to a big management change.
Absolutely. A complete overhaul, really, in late 2024. Peter F. Longo came in as CDO November 24, replacing the previous guy.
And that timing wasn't random. It happened right alongside a new investment.
Right. A $2.5 million private placement from a new controlling investor. The analysis in the source material strongly implies this new investor basically installed the new management team specifically to execute this AGIG-focused strategy.
That makes sense. Longo's background, as described here, seems much more suited to running complex industrial projects, tech scale-ups, not so much microcap oil exploration.
A much better fit for the new vision, yes. The material even notes he took on the CFO job, too, in February 2025, apparently without extra pay. Looks like consolidating control to push this transformation through.
And just to be clear, because sometimes old info lingers, the sources explicitly address this idea that maybe changes happened back in May 2021.
Yes, the material tackles that directly. It says there's no record of significant leadership changes then. The key changes, the ones driving this specific pivot we're seeing now, were definitely November 2024 with Longo's team.
So the idea that the 21 team and the 24 team are somehow working together is just wrong based on this material.
Incorrect, according to the sources. The new team replaced the old one to implement this new plan.
Okay, so a huge transformation, pre-revenue main business. Funding must be absolutely critical. What do the sources say about AGSA's financial health, historically and now?
Critical is an understatement. The sources paint a picture of AGSA having a long history of, well, not making money, negative cash flow, chronically dependent on raising capital just to operate.
So this big pivot, especially AGIG needing development money, it's all being paid for with external cash.
Entirely. It's just continuing and probably accelerating that pattern of relying on the capital markets. The sources highlight two recent raises that were key to even getting this far with the pivot.
That $2.5 million in November 24 alongside the management change.
And another $4.42 million through a direct offering in January 25. And the analysis frames these not as funding growth, but more like essential bridge financing. Money needed just to survive and make these acquisitions happen.
And this constant need for cash leads to another problem the sources detail: reverse stock splits.
Ah, yes, the reverse splits. It's described as part of a potential vicious cycle. The core issue, as laid out here, is the company can't make profits from its operations. So the stock price stays low, often dangerously low, risking its listing on a big exchange like the NYSE.
So to fix the symptom, the low share price, they do a reverse split.
Exactly. The most recent one cited is 1-for-10, effective June 2025. And the stated reason, according to the sources, explicitly to boost the share price to meet NYSE rules for the Abundia acquisition.
And this isn't the first time?
Nope. The material mentions a prior 1-for-12.5 split. It indicates a chronic problem maintaining share price through, actual business success.
And these splits, the analysis is clear, they're just cosmetic, right? They don't actually change the value of the company or your holding.
Correct. It's just share shuffling to meet an exchange rule. Fewer shares, higher price per share, same total value. But given the AGIG deal involved issuing shares equivalent to hundreds of millions before the split, a reverse split became mechanically necessary to keep it listed.
And that creates the vicious cycle the sources talk about.
Pretty much. Poor performance, low stock price, reverse split needed. Then, the company needs more money for its plans. like AGIG's 5-year development. So it issues more shares, more dilution for existing holders, downward pressure on price, maybe eventually needing another split.
And since AGIG is pre-revenue with a long development runway, future funding likely means more dilution is baked in.
That's the strong implication from the sources, yes. Almost certainly more share issuances ahead.
Looking at the balance sheet, the analysis notes something interesting. Sometimes it might look okay, low debt, maybe some cash, but that's misleading.
Right. The sources describe that not as a sign of health, but just a temporary snapshot, usually right after they've raised money. The real problem is the income statement and cash flow.
Yeah, they mentioned incredibly low revenue, like $500,000 over 12 months recently, and a net loss over $9 million.
Exactly. So when you hear things, maybe commentary mentioning only 2 employees or minimal income, the sources suggest that actually reflects the reality of the legacy business's tiny scale and capacity relative to the huge challenge of this pivot. Without positive cash flow from operations, that clean balance sheet doesn't mean much long term.
Which brings us back to the market, the stock price behavior. The sources argue the way the stock trades and who owns it is key to understanding the volatility and that disconnect from fundamentals we talked about earlier, like the Middle East spike.
Definitely. The public float, the number of shares actually available for trading, is described as exceptionally low, maybe 1.3 million shares or so post-split.
And a low float means?
It means even small amounts of buying or selling can cause huge price swings. There just aren't that many shares changing hands easily.
And compounding that, the analysis says, is the shareholder base itself, mostly retail traders.
Heavily skewed to retail, yes. Yeah. Very low institutional ownership. So the stock is super sensitive to, sentiment, social media buzz, whatever the current trend is. It becomes a vehicle for speculation.
Like the frenzy over Middle East headlines, which had nothing to do with HUSA's actual business.
Exactly like that. It fuels these speculative runs completely detached from corporate reality.
The sources even mention this weird thing traders sometimes notice. Daily volume sometimes being way higher than the total number of shares.
Yeah, and the analysis explains that's likely not manipulation, but more a sign of high-frequency trading. Algorithms buying and selling the same shares over and over all day long. It reflects trading speed and volatility, not necessarily widespread ownership changes.
So, low float, retail dominance, high-frequency trading. The sources call it a perfect storm for speculation. Makes the stock a crazy gamble.
That's the language used in the analysis, yes. Price moves driven by headlines and momentum, not the company's actual progress or lack thereof on its strategy.
And that must be incredibly difficult for management, right? Trying to explain this complicated, multi-year renewable energy plan.
To a shareholder base that's mostly watching for the next news alert or price spike. Yeah, the sources highlight that challenge. It's a fundamental mismatch.
A long-term project needs patient investors who believe in the vision.
Exactly. And HUSA's current shareholder base, according to this analysis, is largely the opposite. Momentum players looking for quick flips. That creates big risks.
Like what?
Well, for instance, the sources suggest the actual closing of the AGIG merger, which is strategically vital for the company's plan, could ironically become a sell-the-news event for these traders.
Meaning the stock could crash right when the company thinks it's hit a milestone.
Potentially, yeah. Just as they enter the really hard part, actually executing the plan. The sources note that attracting a different, more long-term investor base is a key unstated challenge for the new team. But there's no sign yet from this material that it's happening.
Okay, what about the original business? Those legacy oil and gas assets in Texas and Colombia. What's their status now, according to the sources?
That's important context. The analysis of company communications suggests they're basically stagnant, not a priority anymore.
So any past announcements about drilling plans, like in the Permian back in June 2024?
No. Updates reported since then in the materials we have. And updates on other U.S. assets, like Yoakum County, seem to have dried up even earlier, back around 2020.
And Colombia.
Activity there, specifically on the CPO-11 block, seems to have stopped being discussed around the end of 2022. The sources point out a real lack of news on drilling or production from Colombia since then.
And the company's own description of its business focuses more on the U.S. now.
Increasingly so, yes. Less mention of Colombia in recent communications described here.
So that's silence. The sources interpret that as pretty significant, not just a lack of news, but evidence.
Powerful evidence, according to the analysis. Evidence that these legacy properties are either not producing much, if anything, or have basically been sidelined as the company shifts all its focus and, frankly, limited resources onto AGIG and RPD. They're just items on the balance sheet, not contributing meaningful value anymore.
Okay, so let's try to pull this all together. Based purely on the analysis and these sources you provided, Houston American Energy Corp today looks defined by, well, a lot of risk.
Profound risk, yeah. Across the board, the sources seem to group it into four main buckets. First, massive execution and integration risk.
Right. Merging two companies, jumping into a totally new industry they've never worked in, trying to scale up unproven tech. It's a huge lift.
Monumental.
Yeah.
And HUSA's history as a tiny company with limited success doesn't exactly scream expert execution capabilities, according to this analysis.
Okay, second risk bucket.
Financial and dilution risk. We talked about this. They don't make their own money, rely on fickle markets. The AGIG merger itself is hugely dilutive upfront.
And likely just the start, the sources predict. AGIG needs tons more cash for its 5-year plan, meaning probably more share sales, more dilution down the road.
Continuously, potentially. Third bucket, market and valuation risk. The stock price being completely untethered from the business reality.
Driven by hype, geopolitics, trading trends, not the actual company performance.
Which creates crazy volatility, the constant threat of a crash, regardless of strategic progress. It makes the stock, as the sources put it, unsuitable for investing based on fundamentals.
And the fourth risk?
Governance and legal risk. That AGIG deal structure, the 94% dilution, it already attracted legal scrutiny, according to the sources. Could cause issues closing the deal, or maybe lawsuits later about fairness.
So boiling it down, the core conclusion from this material seems to be HUSA isn't really an oil and gas company anymore, in practice.
Not in any meaningful way, no. It's essentially become a public listing, a vehicle for this very high-risk, pre-revenue renewable energy venture, AGIG, to access the markets.
And the old assets, just remnants.
Stagnant remnants, contributing no real fundamental value to this new picture, based on the analysis provided.
It really highlights this strange dual reality, doesn't it? The company is over here trying this incredibly complex, multi-year strategic transformation.
While its stock tickers are over there, bouncing around wildly based on news headlines from halfway around the world or whatever meme is trending, totally separate narratives.
A corporate transformation plan meeting a speculative trading frenzy.
That's a good way to summarize the tension described in the material, yes.
So, thinking about all these risks laid out in the analysis, the execution challenges, the funding needs, the market disconnect, the potential legal issues, and knowing from these sources that the current shareholders seem mostly interested in short-term trading. What does success even look like for the new HUSA? How would you even start to value that potential success given all this volatility and uncertainty described here? What really stands out to you from digging into all this? Really appreciate you sending over all these sources. It made for a fascinating deep dive.